Hello and welcome to the next of our revision course lectures. We're going to look here at our question technique for cash flow statements. So cash flow statements is IAS 7, and what I want to give you here is a process to go through to deal with the cash flow statement pretty easily and pretty quickly. But you do have to learn it and you do have to do some of these. Now this comes up all the time. You cannot go into this exam without knowing your cash flow statements. So you must go over this lecture, you must be able to do everything we talk about, and then you must try some of these using the techniques that we look at. So for our cash flow statements, the first thing I want you to do in these questions is to do your cash flows from operating activities. So IAS 7 gives us various headings to use. The first one we're going to do is cash from operating activities, and it's really a reconciliation. It's turning our income statement into cash. Because remember, our income statement is done on an accruals basis. So not everything in there is cash. So what do? Well, we start with profit before tax from our income statement. We then need to look at things above that aren't cash. And what we're going to do is we're going to add back non-cash expenses in the income statement. So we'll look through and find things like depreciation, amortization, those sorts of things that need to be added back because they're not cash. Our interest cost as well will be added back because it's often done on an accruals basis. So we'll assume it's on an accruals basis. So look through the income statement and the notes to the cash flow statement question and add back any non-cash expenses for the income statement. Likewise, we need to go through and subtract any non-cash gains, like profit on a non-current asset or a gain on a financial instrument, something like that. So those need to be subtracted out. So add back non-cash expenses, subtract out non-cash gains in the income statement. Then you deal with your working capital movements. So you need to look at each of your working capital items. So that's your receivables, inventory and payables, and see whether they've gone up or down. So for example, if receivables has gone up, we've got more receivables. That means we're collecting less cash. So that will reduce our cash. If inventory has gone up, that again will reduce our cash because we'll tie up more cash. However, if payables have gone up, well then we're not paying those payables as quickly. So that's actually releasing cash. So deal with those working capital movements there also. So take your profit before tax, add back non-cash expenses like depreciation, amortization, subtract non-cash gains like gains on non-current assets or gains on financial instruments. Then deal with your working capital movements, and that will get us our cash flows from operating activities. So you should be able to do that. You should have seen that before. That's always the first step. That's the easiest bit to do in the cash flow. You'll have picked up good marks even at that point. Then set out a pro forma. Now, you'll not be able to fill everything in, so just put the headings down and leave 5 or 6, maybe even 8 lines underneath each one to bring in any cash flows from the workings we're going to look at later. So the next headings you'll need is cash from investment activities. So that will be things like buying and selling non-current assets. So bringing those in at that stage. Then cash from financing activities. So that will be things like issuing shares, issuing debentures. And at the very bottom, you'll have a reconciliation to the cash movements on our statement of financial position. So what we can do is take our opening cash from the statement of financial position, and the opening cash plus or minus the cash flows that we get in our cash flow statement should equal the closing cash. So we should be able to reconcile our cash flows to see if we are correct. Now, in the exam, it's very unlikely that you'll get that correct because you'll be working quickly. There's always something you perhaps miss out. So put in your reconciliation, but understand that it may not work out, but show the examiner that it should. And we'll look at how to do that when we do an example in a second. Then I want you to go down the balance sheet. So we've done our pro forma for operating activities. We've set out the cash flow statement pro forma. We now need to get the items to fill into it. So the working for our statement of financial position, the one I would like you to use is this. Take your opening balance on whatever item it is. So let's say it's property, plant and equipment at the top of our balance sheet. Opening balance is a positive, less the closing balance. And then we're going to make any adjustments that we're told about. So for example, in non-current assets, property, plant and equipment, let's say we're told that we have depreciation. Well, that depreciation would reduce the opening balance, so it would be subtracted out. If we had some additions, well then that would be added in because that would increase the opening balance. So look for items that will increase the opening balance and add them in. Look for items that will decrease the opening balance and subtract them out. Now, if the examiner gave you everything, so for example, in property, plant and equipment, they give you all of the additions, all of the disposals, the depreciation charge, everything you needed for that account, well then the balance would add up to 0. Now in the exam, it's unlikely to add up to 0 because the examiner will leave something out, and it's the something that's been left out that you're looking for. So when we talk about cash flow statements, really in the exam, it's more akin to an incomplete records question, because let's say the examiner left out additions. Well, if in non-current assets the examiner has left out additions, when we get to the bottom of our working and get a total, that total will come to an amount, and that amount will be the additions that we're looking for. So this is a method to find the item that is missing. So we're going to in a second look at all of the items that are likely to go into our workings so that you can learn those and know what it is that's missing that you're looking for. Now, just thinking about the result that you get, if the result of the working is a cash flow, now it may not be, it may be amortization or something like that, but often the result of your working at the bottom will be the cash flow that you're looking for. So it will either be a positive or a negative at the bottom of your working. So you'll either add it all up and it'll be negative or positive. And it will either be an asset or a liability that you're looking at in your statement of financial position. You need to know how to read the answer, how to know what it is. Well, if the answer that you get is positive and it's an asset that you're doing the working for, so you're doing your working, for example, for non-current assets, the result that you get is positive, well, that is a cash inflow. A cash inflow, well, how would that come about in non-current assets? Well, that would be disposals. You've disposed of a non-current asset. So cash inflow would be a disposal. Now that really is the only one you need to know because you can work everything else out from it. If it's negative, of course, that will be an outflow. And if it's a liability that you're doing this working for, let's say it's a long-term loans, well then it'll be the other way around. If the answer is positive, it'll be an outflow, and if it's negative, it's an inflow. So if you learn that little table, that little chart, that will interpret the answer that you get on your workings. So the steps for a cash flow statement. Number 1, you do your cash from operating activities in your pro forma. Number 2, you set out the rest of your pro forma, leaving lines to fill in the answer from your workings. And number 3, do those workings. Start at the top of the statement of financial position, work down it, do this working for each item that you come to, add the opening balance, less the closing balance, look through the other notes to the cash flow statement and add in things that will increase the balance, subtract out things that decrease the balance, and get a total at the bottom of that working. The result of that working then can be interpreted using your table. So let's think about the sorts of things that you're likely to see. So for example, let's say you do your working for property, plant and equipment. So your opening balance less your closing balance. Well, what sort of things will appear in this account? Really, this is a ledger account and we're just posting in everything that we have on it. So disposals, for example, well, they would decrease the opening balance. So we'll subtract them. Additions, the opposite. They would increase the opening balance, so we add them in. Depreciation, we subtract out because it would decrease the opening balance. Impairments would decrease it also, and a revaluation would increase the balance on our property, plant and equipment. Now, if all of those things were included, that would add up to 0. In the exam, you'll post in everything you've got. The total may well not come to 0 and one of those items will be missing. So maybe it's additions you're looking for. Maybe it's a revaluation. So those are the things you need to look for. Your addition in the exam will not add up to 0 because something will be missing. And you need to know each account well enough to know what it is that's missing. So for example, in investment properties, the opening balance added in, the closing balance subtracted out. The things that would appear here, additions we add in, disposals we subtract out. A gain on the fair value of an investment property would be added in to increase the opening balance. A loss on the fair value would be subtracted out. If all of those items were there, it would add to 0. If they weren't, well then we'd be looking for some of those. Now additions, for example, would be a cash flow because we bought more investment properties using cash. A gain on fair value, well that would be an item that we would have to deal with in our cash from operating activities. It would be subtracted out in our reconciliation. So you can see here that this working is telling you the different things that you could be looking for. So it might be a cash flow, it usually will, but it may also be a fair value adjustment like this one. For intangible assets, opening balance, then the closing balance, you would have new expenditure, a cash flow, amortization, not a cash flow, would be added back in our reconciliation at the start. If they were all there, it would add to 0. You'll usually be looking for that new expenditure that would be a cash flow that we'd spent in the year. And of course, that new expenditure would appear in cash from investment activities. So when you get your answer from these workings, you can then bring it into your pro forma. So that would appear in investment activities. Additions of property, plant and equipment would appear in investment activities also. For financial assets, so these would be equity instruments at fair value through profit and loss. Opening balance, closing balance, additions, disposals would be cash flows. Gains or losses on financial assets would be things to add back or subtract in our reconciliation for cash from operating activities. If everything was there, it would add to 0. Remember, it won't add to 0 usually. You'll be looking for one of these additions or disposals as a cash flow, and those would be shown in investment activities. Gains or losses, those would be in our income statement and would need to be dealt with in our reconciliation of cash from operating activities. For share capital, well, our share capital will have the opening balance and closing balance, and then any issue of shares would increase that. It may well be that we're looking for that issue of shares as a cash flow from financing activities. For long-term borrowings, we'll have the opening balance, the closing balance, repayments in the year, and new loans. Both of those would be cash flows. One of those will be missing, and the total would add to 0 if they weren't. Lastly, for the tax charge, we have to combine our tax due and our deferred tax because the charge to the income statement includes both, so we can't separate them out. So we have the opening balance on our tax due, the opening balance on deferred tax, and the closing balance on our tax due and the closing balance on deferred tax. The tax charge in the income statement will be added back, and the balance we will be looking for is the actual tax paid in the period. So the tax paid will be the total that you will come to. So let's see if we can do all this. We're going to look at December 11, question 3, part A. And what I would like you to do is to have a go at this one, particularly the opening reconciliation to cash from operating activities. What you'll find is for a lot of this question, we have to combine things in our workings. That's why I wanted to particularly look at this one, because for our share issue that there's been, we'll need to compare 3 different accounts in our working, and in our long-term borrowings, we'll need to combine some accounts on that. So at least do the cash from operating activities, try some of the workings as well, and then work through the answer with me to see where we go. So we're looking here at December 11, question 3. Please make sure that you have had a go at this question, especially the first part, the cash from operating activities. You'll need to read through all of the notes that you're given so that you understand them, and then attempt that reconciliation at least. If you want to, then also try the other workings in the way that we discussed in the revision session. The first step we always take in our cash flow statement, we set up our pro forma to reconcile our profit before tax to our cash flows from operating activities. So profit before tax from our income statement is 3,900. The things that we know definitely always get added back, well, we have finance costs in there of 500. We always add those back. We also have finance income. So it was not an expense but income, so we'll subtract it out because it was added into our profit before tax. And then of course our depreciation. So looking through the information we're given, in note 1 we can see that there was total depreciation for the year of 2,500. So we need to add that back. So make sure when you're doing these you always look through all of the notes and the information you're given to do your reconciliation. Because there's also a couple of other things in here. There's a profit on the sale of the non-current asset. So we're told in note 1 that the property was disposed of for 8.1 million. Now looking at the property, we can see that the carrying amount of the property was 4 million at that time. So that means that we've got an included amount here of 8.1 minus the 4 million, 4,100. Okay, so that means that we've had a profit on the sale of a non-current asset. It's included in the income statement, so we need to subtract it out. So that information comes from note 1. We also then are told in our note 4. In note 4, the movement in the product warranty provision has been included in cost of sales. So looking at the statement of financial position we're given, we can see that the warranty provision is down at the bottom there in our current liabilities. It has moved in the year from 4,000 to 1,600. So the movement is the 4,000 to the 1,600. That movement has been included in cost of sales. Well, that's not cash, so we're going to have to subtract that out, 2,400. It's a decrease in an expense, a decrease in an accrual, so that means it's effectively been credited to our income statement. So what we need to do is subtract that out. So that means that we've got our total of 4,600, which means our operating cash flow before our working capital changes is 700 of a deficit. Looking at our working capital from our balance sheet then, starting with inventory. Inventory has gone up from 7,200 to 10,200. So that's an increase of 3,000. So that means that that's tying up more cash. So that's going to decrease the cash available in the business. Receivables, well, they've decreased. They've gone from 3,700 to 3,500. So that decrease, well, that will free up some cash. So that's 200 of cash freed up. So an increase in cash of 200. there has been a decrease in payables. It's been from 4,600 to 3,200. Now, what does that mean? Our payables have gone down. Well, that means that we've tied up more cash because we've paid those. We paid them more quickly than we did previously. So that means that we've had to pay out more cash than last year. So our decrease in payables will tie up more cash. So that means that taking that total, we can say that our cash generated from operations was negative. It's a deficit of 4,900. So that's our cash generated from operations. Now our key thing is to go down the statement of financial position, and for each item that we come to, we'll do a working. Once we've done all the workings, we'll bring it all together in the rest of our cash flow statement. Looking down our statement of financial position, we first of all see property, plant and equipment, but we've already dealt with the movement on that in our reconciliation. So the next balance we come to are financial assets. So let's do our working for this to see if there are any cash flows we need to deal with. The opening balance on our financial assets, well, that was 7,000, less the closing balance of 4,500. Now, looking at the other information, we're told that we sold a financial asset during the year. We sold that financial asset and it had a value of 3 million. So that's 3,000 in our working. So the sale of the financial asset removes the carrying value, which was the 3,000. We're also told in our table that there was an increase in the fair value on our investments. The increase in the fair value on our investments will have increased the balance by 500. So in 2011, the increase was 500. So that's all of the information we need for our financial assets. If we add that up, well, we can see it actually does balance. So it balances, and that means that there are no cash flows to deal with in our financial assets. But you need to check just to make sure that there's nothing that you miss. Moving down the balance sheet, the next thing we come to is inventory, but we've already dealt with that. Receivables, we've already dealt with that. Bank we'll come to when we get to the end of our cash flow statement, so I'll show you how to deal with that. So the next balance we need to deal with is shares. Now we need to look at note 3 for this. So note 3 tells us that there has been a share issue. So there was a bonus issue of shares that was funded from the share premium and some of the revaluation reserve. Now, what that means is a bonus issue means we've issued shares for no cash. So we'll need to deal with that. But also there's been an issue of shares for cash at par. So there has been some issue of shares for cash. Now, if you've got some transactions here that deal with various different accounts, we can group them together in one working. So we have shares issued that are going to affect 3 of our accounts. They're going to affect our ordinary shares, our share premium, and our revaluation reserve, because the bonus issue went through the revaluation reserve and the share premium. And the ordinary share issue will deal with the balancing figure, really. So ordinary shares were 8,000 last year, share premium was 2,000, and the revaluation reserve was 3,600. So let's bring them all into the working together. So the closing balances on each of these were 14,000 for ordinary shares. For our share premium, it was 0. And for our revaluation reserve, it was 2,000. So obviously the share premium has been used up with the bonus issue, and some of the revaluation reserve has also been used up. If we balance that all off, we can see that we still have 2,400 to deal with. Now that means that is the shares that we issued for cash in the year. That is our cash flow. The movement on the premium and the reserve, some of it went through the bonus issue. The rest of it, the balancing figure, was the cash that has been issued in the year. That is our cash flow. And of course, if we issue shares, we do that for cash, so we get cash into the business. The next balance that we need to deal with, well, we look at retained earnings, but we can see that it has moved in the year, but it has only moved by the profit in the year. So the profit for the year was 2,900. 10,100 plus 2,900 gives us the closing balance of 13,000. So there's no dividends paid or anything like that on retained earnings, so we don't need to deal with it. The next one we need to deal with is our finance lease obligations. Now be careful on these ones because we have finance lease obligations over non-current liabilities and we have some incurrent liabilities. So we need to again group these two together because our finance leases will be both of those together. So the opening balance on our current leases was 2,100. Our opening balance on our non-current leases was 6,900. Our closing balance on each of these were for current leases 4,800 and for non-current leases 7,000. Now looking at our table for our property, plant and equipment, we can see that we had new finance lease additions of 6,700. So new leases in the year were 6,700. Adding all of that up, we get a balance of 3,900, so it doesn't balance. So what is this? The difference will be the leases repaid in the year. So that's a cash flow. Remember, we'll be making payments on our leases during the year. The difference, therefore, will be those leases that we have repaid in the year. That is our cash flow that we are going to take to our cash flow statement. Moving down the balance sheet, we now come to deferred tax. So this is another linked balance. Remember, our movement on deferred tax goes through the income statement with the charge for the year for our income tax. So we need to bring these two balances together. So in your workings for cash flow statements, your deferred tax and your income tax payable will be brought together in the working. So we have our opening balance on income tax. So income tax payable is 1,200. The opening balance on deferred tax, well, that's 900. So the closing balance on each of those for income tax is 1,000. For deferred tax is 1,300. We also have the income statement charge that increases the tax due. Remember, that will wrap up both the movement on our income tax charge and our deferred tax. And it was 1,000. It doesn't all add up. There's a balance. The balance is 800. And of course, that's the amount of tax paid during the year, which is a cash flow. So looking on down the statement of financial position, we've dealt with everything else. We've dealt with the provision for warranties, the finance lease obligations and the payables. So that's all the workings we need. We can now bring this all together and do the rest of our cash flow statement. Picking up our cash flow statement from our cash generated from operations, so we've done our reconciliation and got to that point. Let's finish it off with the information that we have from our workings. So once we've got our cash generated from operations, the next thing to do is to first of all deal with the interest paid. We subtracted out our finance costs and our finance income in the year. So what we need to do is check, well, what interest did we actually pay? We're not given any information on interest, so we're going to assume that the interest paid was the cash amount. We're not given a balance in the statement of financial position, so therefore we assume that we paid it on a cash basis. So interest paid was 500. We then deal with our income tax. We did that in working 4. The income tax paid in our working 4 was 800. That gives us our net cash deficit from operating activities of 6,200. Now dealing with our other headings, our cash flows from investing activities first of all. Well, cash flow from investing activities start off with your property, plant and equipment. So we had a purchase of property, plant and equipment and it was 8,300. We're told that in the notes. We're also told that there was a disposal of property, plant and equipment for the 8.1 million, so 8,100 disposal, so we got that cash in. Remember, we also disposed of that financial investment, so we disposed of that and got 3.4 million, so that's cash in as well. Also, looking at the table for our investment income, we received some dividends. We received dividends in the year of 200. So dividends received 200. That gives us our net cash from investing activities of 3,400. Moving on to our next heading, we have our cash flows from financing activities. Well, we dealt with our share issue in working 2, and we found that there was 2,400 of shares issued, so that's money in. We also, in our next working 3, dealt with the payment of finance lease obligations, and we worked out that we'd paid 3,900 in the year, so that's going to be cash out. Nothing else to go in here, so that gives us our net cash from financing activities. So all of that added up will give us the net decrease in cash and cash equivalents of 4,300. So our total cash, and it's a decrease in this instance, is 4,300. Now we can check whether that's correct or not, because we're told in our statement of financial position how much cash we actually have in the business. We're told that the cash brought forward, if you look at the statement of financial position, the cash brought forward was 1,400. So in our cash on our statement of financial position, we had 1,400 in 2010. Now that cash had disappeared by 2011, but if we look down to the bottom, we had a bank overdraft in 2011. So the cash and cash equivalents carried forward in 2011 was 2,900 of an overdraft. It was negative. So we can see that that works. Our 1,400 brought forward less the decrease in cash and cash equivalents that we've calculated in our cash flow statement gives us the cash and cash equivalents carried forward into the next year of 2,900. So we know that the cash flow statement is correct. Now in the exam, put those headings in, put the reconciliation headings in, but if it doesn't reconcile, do not spend a lot of time trying to make it reconcile. Move on to the next question as soon as your time allocation is up. But theoretically, you should be able to reconcile that to see whether you've got your cash flow statement correct.